So most of y'all already know me, you know what I'm all about. And essentially, what I think is that everybody here, if not doing already super good on the exam, will be able to do super well on the final. I really do believe that. And especially when you have the right perspective and the right trick for you. So that's kind of what I want to do. We have quite a few sessions. I believe we have 6 sessions. If I just look at our calendar, and if you don't have the Google invite, just let me know. You can send me a text. So we're going to have tonight, we're going to look at chapter 10. We're going to have Sunday, in which we're going to look at chapter 12, if I'm not mistaken. And we're going to look at the next week, in which we have like 4 sessions: Tuesday, Thursday, Sunday, as well as Saturday. So there's a lot of sessions available. That's why the bootcamp is super cool. Is there final notes for chapter 9, 11, and 12? We're actually, how we're going to go about this, Olivier, good question, is that every session for the first 30 minutes, we're going to be creating like our notes. And the reason why I want to create notes together is because you'll actually, like, you would have done them with me. You're going to know exactly what these things mean and exactly why they matter. So that's how we're going to go about it. Every boot camp, even for our review, we're going to spend a little bit less time on a review, but when we're doing like chapter revisions, we're going to spend some time and build some notes together. And we're going to really make sense of all the stuff that you need to understand to be able to break down the problem in a super like straightforward and solid way. So that's a little bit the perspective here. Do I have to say anything else in terms of like clerical stuff? If you want to open your camera, you don't have to. I know this is recorded. It's for the people of the bootcamp who like can't make it for the whole session, but we're going to be spending like 24 hours together, right? For the next 2 weeks, we're going to be spending a lot of time together. So it's always fun if we could have some interaction. And how I'm going to do this is I'm going to ask you all to participate. I'm going to ask you to use the chat, raise your voice, just like that. I don't look at my webcam, you know, the whole evening and the evenings to follow. Another thing that I'd like to say is if you're not in the group chat, let me know, because I'm pretty sure we're all supposed to be in it. I'll add you in it. Like that, you could ask questions. Like that, you could share solutions. And like that, I could kind of like point you towards the right direction if when we're doing like the homework part, you have some external questions. And that's also where I'm going to post the recordings. Yeah, sure, no problem. Another thing that I like to say is that I think that teaching in person is really fun. So on Saturday and Sunday, and even Monday, like the days before the exam, if you all feel comfortable, I know there's a 6th wave coming by, and etc. If you feel comfortable, I would be open to doing that session in person because I feel like that is more relevant. Yeah, Leandra, they're actually all on my Vimeo, so they're all in the link. So I just need to convert them and send them. Can you just send me a text on Messenger saying, "Hey man, notes chapter 6, 7, and 8, and past recordings." Like that, I will make sure not to forget. And it's actually also recordings for the previous chapters as well. So it's chapters from the past as well. Okay, so I think that's pretty much it. So that said, what I'm going to do is I'm just going to share my screen and we're going to get started. We're going to have some fun. We're going to look at the theory and then we're going to jump in the practice problems together. So share screen. All right. So how I like to do this, and I'm going to be asking a lot of questions as we go, just to make sure that we're on the same page, is a lot of things that I believe chapter 10 is not that difficult. I think that chapter 10 really does make sense. We just got to take baby steps to get there. Understand what is the transaction all about? What are the key components that we see? And how do they all like kind of work together? What are the different stakeholders in this thing? And we're going to try to put ourselves in this scenario. So I'm going to put a 30-minute alarm. Well, in this case, 23 minutes. We're going to try to make sense of this. And then after every section, we're going to take a 5-minute break. So we could all like go get some water, go pee, get a snack, because we're going to be here for a while. So the first thing that I'd like to do is what we're going to do is we're going to zoom in a little bit. This is a theory section. And we're going to try to identify a bunch of different words that we've heard when we looked at chapter 10, right? Because we're looking at chapter 10, we're looking at a bunch of different definitions, but like, what do they mean? So we're going to have topic, we're going to have definition, then we're going to give an example. All right, so we're going to have 3 different buckets. All right. So what I'm going to ask y'all is to tell me a few different, whatchamacallit, definitions or like a few different terms that you've heard in chapter 10. Literally anything is okay. I need at least 5, and there's much more. So when we look at chapter 10, what are we talking about? What are the things that we're usually looking at? Somebody put that in the chat really quickly. What are we looking at when we're talking about bonds? Like other than bonds, like what are we looking at? Any key terms in mind? You could just write in the chat or you could raise your voice. It's really up to you. Okay, nice. Thank you. Good. You guys are killing it. Dope. All right. So we have face value. What else do we have? We have issue. Okay, so issuance date. Okay, we have repurchase. Yeah, repurchase. What else do we got? More things. It could be really like basic stuff. I'll add one. So time to maturity. Like it doesn't have to be complicated, like extravagant stuff. Compound rate, coupon rate, sorry. Nice. What else do we got? We're doing good. What else do we got? Other than this, we have bonds. Okay, that's good. Yeah, for sure. So what is a bond? That's good. What else do you guys got? I'll ask for 2 more, and then I'll add a few other ones. I need 2 more topics within this chapter that may be relevant. Nice. There you go, Amadou. That was the one I was looking for. Yeah. Market rates. Amazing. I think maybe other things that we would need to look at is maybe amortization, something that we discuss a lot. We could say at par. These are a few different definitions, a few different topics that we need to understand. So what we're going to do now is we're just going to add some quick definitions to them. You don't need to totally understand them yet. We're just going to use them as a point of reference for when we're actually going to try to we're going to try to create like a chart, a visual for this whole scenario. Okay. So I'm going to add a few different definitions. We're going to have bond holder and then bond issuer. All right. So 2 different names. Bond holder. Okay. Good stuff. So we have a bunch of different things. So a face value, how I want you to understand this is the face value is the value of the bond. Okay, the value of the bond, and in other words, the value of the debt. Okay, the value of the loan that's happening. And don't worry, we're going to make sense of it a little bit more. So just a few terms: value of loan / debt, i.e. bond. So that's all that you want to know. Just some quick reference points. The issuance date is the initial date at which the bond was issued. It's like literally at the beginning of the problem. Repurchase, companies, governments, institutions may want to repurchase the bonds they issued in the past. So, okay. So before I continue to the time to maturity, are we okay with the idea of face value? Like really quickly, does that make sense what I wrote? Like, are we cool with that? Any questions? Okay. If you have just say yes or like the why if that's the case, and like in the chat. Issuance date. Are we okay with the issuance date? Does that make sense to us? Seems like it's an okay. Repurchase. Do we understand that maybe somebody would want to repurchase their bonds? Yeah. Just say a no if that's not the case. Cool. Now, a time to maturity is how long the bond will exist, right? From the date of issuance all the way to the date of maturity, right? So just the lifespan, the timeline of that bond. So for how long will this bond exist? Although kind of a bad way to define it. The coupon rate. So the coupon rate is super cool. Essentially, the coupon rate is the rate we're going to use to define what payments the bond issuer will do. So to make it simple, coupon rate is a percentage that you're going to apply to the face value to figure out what your annuity payments are, to figure out what your coupon payments are. Once again, just quick little, like we're throwing spaghetti on the wall And I just want you to internalize these things before we put them into a chart and then before we do practice problems. So important rate to figure out the future payments. All right, and then the bond is the loan debt raised by company. Market rate, I'm kind of just throwing at it. The market rate is the percent of the percent that average companies will pay on their bonds. You know what? And what we're going to do now, I think it's best practice if we just jump straight into our problem. Okay, we're going to go straight into the problem. It'll make more sense. It'll be more fun. Definitions are boring. So we're going to draw this out. This is a little box. Oh, somebody's trying to join. Nice. Okay, we're going to draw this out. This is going to be a little box. Okay, we're going to have text in it, and we're going to call this the bond issuer. Now, what are examples? Yeah, no problem. Sorry about that, Daniela. Great point. So what are examples of bond issuers? We kind of like talked about them 2 seconds. So what's a bond issuer? Who would issue a bond? Who is allowed to issue a bond? Just throw me a name out there. Could it be a company? Could it be a person? Could it be, what would it usually be?
Company.
Nice, perfect. So we're going to answer who as being companies, institutions, and governments may issue bonds. Okay, this is more fun. I like doing this better. Okay, so then we're going to say, why would they issue a bond? Why would somebody issue a bond? Can somebody answer that question? This is like philosophy, like c'est comme philosophe là. Il faut que tu saches pourquoi. Why are they issuing bonds? Why would somebody do that? Somebody tell me in the chat, like anything. No answer is wrong here. Why would somebody issue a bond?
To get some money.
Couldn't have said it better myself. So the reason why somebody would issue a bond, and in this case, somebody is a company, institution, or a government, is for future benefits, sure, but it's also to gain cash like today. So the reason why somebody will issue a bond is to raise money. I love that definition by Hussein. Exactly. It's to raise money. Amazing. Okay, but when will this money be raised? When am I gaining that money? Is it today, tomorrow, or in a million years? When is the bond issuer getting that money? Can somebody tell me in the chat?
Right away.
Right away. Nice, exactly. Today, i.e. right away. All jokes aside, I know I'm like being energetic, but when I say terms such as right away or today, it's just to give a perspective on the problem, right? When we do problems, there are different dates that are provided, and those dates are typically defined by years. For example, 2013, 2014, etc. When we're saying today or right away, we literally mean like at the first journal entry, the first thing that exists within this like transaction, okay? So that's what I mean. So just to recap, we know we have bond issuers, right? These are companies, institutions, and or governments that can issue a bond. And the reason why they're issuing bonds is because they're trying to raise money, and they're trying to raise that money today. Now let's talk a little bit about how. So for sure, you're raising money, right? We're gaining money. I think we're all pretty happy with that. But what do they need to give in exchange to raise that money today? So in other words, sure, the bond issuer will be raising money, but what do they need to give in exchange, right? So how does this happen? What do they need to give in exchange? Could somebody try to answer this question? There's literally no wrong answer here. It's kind of like ambiguous. So what are they going to give in exchange?
They give interest back, no?
Exactly. Amazing. So bond issuers are companies, institutions, and governments who want to raise money today. And in order for them to raise money today, they're going to provide future interest payments and they're gonna essentially repay the money they've received today. So I'll give you guys an example in a second. So they're gonna give future interest payments, and they are going to repay the money they've raised. So what does that mean? Let me give you an example. All right. So now we've discussed what a bond issuer is. Okay. So we know what a bond issuer is. We'll keep it like that. Sure. Now, let me just give you a quick example of what a transaction like this would look like. So let me just try to move this. So we're going to put it like that. All right. So how this is going to happen is that we're going to have two types of people. All right, we're going to have them here. We're going to have the bondholder and we're going to have the bond issuer. And just for, we're going to say government, right? The government can decide to issue a bond, right? So we have a bond issuer that could be the government. Then we could have a bondholder, which is going to be us, the public. So we're going to say the public / us. All right. So is everybody okay with the idea that we have the bond issuer and that we have a bondholder, and that the bond issuer is the government and the bondholder can be the public, or in this case, it's going to be us, our little group today. Is that okay? Could I see a bunch of yeses in the chat real quick, just to make sure we're on the same page? Cool. Thank you. I know I'm being annoying, but it's all going to make sense. And I think it's pretty important. All right. So we draw out another one. Okay. All right. So do we understand that they're going to have a relationship? Something's going to happen. The bond issuer and the bondholder will interact. Do we understand that? Just quick yes in the chat. They're going to interact. Perfect. Cool. So now what we're going to do is we're going to look at each portions of this interaction. We're going to look at the first example. So we're going to look at what the bond issuer gets, and then we're going to look at what the bond holder will get in exchange. This will give you an amazing perspective on the whole matter. Backward, we're going to put this on. All right, so this is a transaction. So, and we're also going to look at this being like today. So right away / at issuance. All right, so we're looking now at the relationship between the bond issuer and the bond holder, and the time at which we're looking at this is today. In other words, right away, or in other words, at issuance. Okay, so if we go back to our little description that we had here, right? We know that the government wants to raise money today, and in exchange, the bondholder, right? If we're looking at today, what will the bondholder get? So today, what is the bondholder going to get from the bond issuer today? What are they going to get? If you had to like say a few words, what do you think they're going to get? What are we going to get from the bond issuer today when we buy it from them? What are we going to get?
Money.
Is it okay? So that's amazing. So we have the bond issuer, we have the government. All right. We have the government, and we're going to have the public, or i.e. us. Today, essentially, what we're going to get, and I'll put it in simple terms, is what we're getting nothing. We're getting the right of having future payments from the bond issuer, right? And I'd like to give you guys a pretty good example. Let's say you went to the bank, okay? You went to the bank because you want to buy a new car. You asked them for $20,000. But in this case, what we are essentially asking the bank, we're going to raise some debt. So we're issuing some debt, right, of the value of $20,000. And the bank will have the right to gain their money back in the future plus interest payments. Does that make sense? Like, are we on the same page? Right? When we go to the bank, we get money. Okay. But the day the bank gives us money, they're not getting anything, right? Does that make sense? Let's go back. Let's do it one more time. If we all go to the bank today to raise $20,000 because we want to buy a car, is the bank going to get something in cash today? Yes or no? We're going to the bank. We're asking them money, right? They're giving us $20,000. Are they receiving cash at that same date? Yes or no? I need to see a lot of no's in the chat. Yes or no? So I only see Leandra and Daniela. What about the others? No. Okay. Okay. So what I'm trying to say here is that the company, the government, needs money. So they're going to ask for some money. The bondholder, which is us, are going to give the government some money. Call it $1 million. But because we gave them money today, we're obviously not getting money back on that same date, right? What we're getting, we go in orange or rose, what we're getting is the right to have money in the future, way in like 2030, right? We're getting the opportunity of gaining money in the future, okay? I guess what we could do is we could look at it from another perspective. We could look at it from the other perspective. So, whoops, let's do this. Now let's look at it as the public, us. Okay, this is important. All right. So today, the government, right, who issued a bond. All right, I'll give you more example. Let's say they issued a $500,000 bond, right, with a time to maturity of 10 years and frequency of payments annual. Okay, so let's look at it again one more time. I need some people to interact in the chat, so we will make it a little more concret. So let's say we are the government. Okay, are we all okay? Who are we? Write in the chat. Who are we right now? From what perspective are we looking at it from? The gov. Okay, I need to see like two more so I can see that people are they're tracking. Okay, cool. So we are the government. We're going to issue a $500,000 bond. Okay, so essentially, we are the government and we're issuing a $500,000 bond. So the public, us, right, a random person on the street, un petit bonhomme, right, will buy one bond. They're going to buy one bond from us, right? So how much money did we get from the public? How much money did we get from this person? Can somebody tell me? $500,000. Okay. Do other people understand that it's $500,000 that we got from this person? Perfect. This is Ismail. Amazing. So this person gave us 500K. All right. But because the time to maturity is 10 years, this means that sure, they gave us 500K today, but in 10 years, right? After 10 years, if this is today, in 10 years, this is going to be 2032, we're going to need to give them their 500K back. We're going to need to give them their 500K back because essentially what a bond is, it's only but a loan. All right. So let me go back at this. Today, we are getting 500K. Are we all okay with that? Quick yes in the chat. Cool. And in 10 years, we're going to have to pay them 500K back. Are we okay with that? Quick yes in the chat. Right? Because it's a loan. Do we understand that we're getting money today, but we're going to have to repay it in the future? Good. I'm going to take that as a yes. But now let's look at it from our perspective. Let's say your mom came to you, right? She comes to you, she runs out to you, she says, hey, Leandra, I need $500,000 from you, okay? But I'm gonna give it back to you in 10 years. Leandra, would you say yes? If you know you need 500K, would you say yes or no? You would say yes, so you're a good kid. If your mom asks you $500,000 and you say yes, Exactly. Boom. Now we have an answer. So yeah, we would only be ready to give so much money if we know we're going to get some interest, right? We would only be okay with this if we would know we would get some interest. In this case, let's look at it. Let's say that the coupon rate is 5%. All right. So can somebody tell me, like, can 3 people in the chat tell me what would be the interest if our coupon rate is 5%? And we know that the bond is 500K. What would be the interest? What would be the interest? There's no wrong answer. Okay, thank you, Amadou. 25,000. Is everybody else in the chat okay with that? Do we understand that if our bond is 500K, that the coupon rate is 5%, we're going to have an interest payment of $25,000. Okay, then let me ask you another question. Who is going to pay that interest payment? Who's going to pay that interest payment, and who's going to receive it? I need to see that in the chat. Okay, and who receives it? Just for fun, just playing with y'all. Exactly. Okay, amazing. Thank you. Really good stuff. Really good stuff. Okay, so the reason why it took so much time to explain this is because I want you all to understand. A government, right? They may need some money. We always hear about this idea of we're in a deficit. So how do they raise money? They raise money by issuing a bond, which is just a fancy word for they're getting debt. They're asking for loans, right? It's a bunch of loans. So they're going to raise this loan of, call it $500,000. In exchange, they're also going to give 5% or whatever percent every single year or every single period. And that's why people like us would be okay with making that bet. So we understand that. The last point that I want to be able to explain, we're going to go a little bit over the theory time, is because I really want y'all to see something. Okay. So let's copy this. Let's copy this. And we're going to call this part right here. We're going to call this the market. All right. We're going to call this the market. And we're going to copy this one. So what I'm going to do is we're going to look at a little scenario that's interesting. So we're going to have bond issue number 1. And we're going to say that we're going to define a few points. We're going to say that the face value, put this in red. I'm going to say that the face value is 500K. Say the time to maturity is 10 years. Frequency of payments annual, coupon rate 5. I think that's pretty much all you need. Okay. So another one here. I have another one here. All right. Then okay. All right. This one will be, call it 100,000. This one will be for 19 years. This one will give you a coupon rate of 3%. And this one will be, call it at 200,000. And this one will be at 100,000, but for 20 years, the coupon rate of 1%. And this one will be $5 million. Okay. So I think we all understand, and I'm trying to make it painfully obvious, is that in a market, we could have a bunch of different like bonds, right? We could have a bunch of different bonds at the same time, and we could have a bunch of different bond issuers. Are we all okay with that in the chat? That in a market, we could have a bunch of different companies or governments that are trying to raise some debt. Does that make sense? Quick yes in the chat. Cool. Okay. So that's one thing. We understand that a market could have a bunch of different bonds and issuers at the same time. Let's say. So that's really important. We know that a market could have a bunch of different bond issuers and a bunch of different bond holders at the same time. Now, why is this important? And what will this lead us to? The reason why this is relevant is because if the public, if people like you and me have l'embarras du choix, have the opportunity to choose which bond we want to buy or which bond issuer we would like to look at, it means that we have a decision to make. It means that we will decide where we were going to want to put our money, right? We may decide to put our money on bond issuer 1 and not put our money into the bond issuer 6. Does that make sense? Just a quick yes in the chat. That we could decide which one we want to go for. Yeah? 100%. Cool. So we understand that we get to make a decision, and we understand that all these different bond issuers and bonds are different. Okay? So by definition, we're going to have to make a decision. Some bonds will be better. And because some bonds will be better, we'll be ready to pay more. And because some bonds are not as good, we'll be ready to pay less because we don't want that. They're kind of trash, right? So there's this play, okay? There's this play. But because we want to make it easier for us, because we know right here, there's a bunch of different values available, I think we could kind of say if we added all of these numbers together, we would have the average face value. Does that make sense? If we added all these face values together, we would find our average face value. Yes or no? Quick yes in the chat. I need to see a few other yeses. Right? Okay. So there are a bunch of different bonds, and we could add all of them together to find the average value of the bond, the average time to maturity of the bond, and the average coupon rate of a bond. Do we understand that we could find the average of all these bonds? I need to see 8 yeses, just because I want to be annoying. Because this will lead us to the final perspective. Leandro, you're saying yes. I know you out there. Perfect. Okay. So the reason why this is important is because the average is what we call the market rate, the market bond, and i.e. the market rate, right? So all these different things may lead us to have what we call a market rate and a market bond. So the market bond could perhaps have a face value of $800,000. Its coupon rate could be 6%, right? But because there's a market rate and because there's an average, right, the normal, this may lead to problems if one bond provides a better face value or requires more money up front and provides a better coupon rate, right? This may create some problems. So let's try to make sense of this in a quick and easy way. So we're going to go at the top here. So before we continue on the last theory point that I'd like to cover, do we have any questions really quickly? Any ideas? Something that wasn't too clear? Now's the time, I believe. No? Okay, no problem. No problem. So what we're going to do now is we're going to look at different scenarios. We'll look at a few different scenarios. We'll look at 3 different scenarios. Okay. So let's say that the average, I'll put this as, okay, so let's say that the average bond we're going to look at is at $1 million, right? For this company. This company has a face value, is going to give you a bond with a face value of $1 million. And we know that the coupon rate for this company is 5%. All right. So we're going to look at that. And we're going to look at 3 different potential market rates. Okay. We'll look at 3 different potential market rates. So we're going to look at a scenario in which the market rate is 5%. We're going to look at a scenario at which the rate is 3%, and we'll look at a scenario at which the rate is 6%. All right. And then we're going to look at what this means. So what's the insight? Right. Then we're going to look at the annuity payment from company. Sorry about that. I'm just trying to make this super clear. And then we're going to look at the implication. The so what. Alrighty. So what? Put that in bold. Okay. So what I'd like to ask the people in the chat really quickly, you could raise your voice, by the way, because I know sometimes the chat is a little bit awkward. Like, you know, you're not sure if you want to type. So you could just go for it and really just like share your idea. So if the coupon rate, right? Before we begin, let me just do a quick question. Do we understand that this is the values of a specific company, right? This is just for one specific random company. Is that okay? Do we understand that? Quick yes in the chat. We're good with that. It's just one random company. And then we're comparing it to a bunch of different market rates. So a bunch of different averages for the market, okay? So if the coupon rate is equal to the market rate, does it mean that the coupon rate is equal to the market rate? Does it mean that the coupon rate is bigger than the market rate? What does that mean? Quickly, easily. Perfect. It means that it's at par. Thank you so much, Amadou. You are killing it. Good stuff. Okay. What happens if the coupon rate is 5% and the market rate is 3%? What does that mean? Somebody write that in the chat. Like, just tell me what's the insight. Is it bigger, smaller? What happens? So the coupon rate is equal to the market rate. Is that correct? If this is 5% and this is 3%, can we move on? Is this true? What is the relationship? It's CR, the coupon rate, is bigger than the market rate. Okay. And just to make it a little bit more obvious here, the coupon rate will be smaller than the market rate. Okay. So we have three different scenarios. We have a scenario at which the coupon rate is bigger than the market rate. And we have a scenario at which the coupon rate is smaller than the market rate. So you guys remember what we did before? If the face value is $1 million and the coupon rate is 5%, and these payments are done annually, let's say, what would be the company annuity payment? What would that be if it's 5%, the coupon rate? What would that be? What would be our annuity payment in that case? If it's, thank you so much. Nice, Leon. Okay, so we know that the coupon annuity payment will always be 50K. So now what happens if the market rate is also, what happens if the market rate is also 5%? What would be the market annuity payment? The answer is what? What would be this thing right here? But thank you so much. I'm being annoying, but I just want y'all to really, you know, get in there. All right, so what happens if it's 3%? What's the answer at 3%? Thank you. Amazing. What about 6%? Quick. Nice. Okay, so let's go back to this idea of the market really quickly. And I think you guys are so sharp that I don't need to spend too much time on this. Obviously, if we're looking at the market, we're going to choose the best possible bond, right? We're going to choose the best possible investment. Now, what we're going to do here is we're going to assume that all things are constant except for the market rate. So all the bonds in this market have a face value of $1 million. All the bonds in this market last for like 10 years. And all the bonds in this market are going to pay you on an annual basis, such that the only possible thing that's different, okay, the only possible thing that could be different will be the market rate. All right, so now let's look at these two. In the case that everything else is the same and that the company is paying you the same amount as what the market would pay you on average, would we care or would we just be indifferent? Would we be indifferent, yes or no? Can somebody answer that in the chat? Would we care in what we invest because it's the same? Or are we indifferent? Like we're good with whatever. You could try to like, exactly, perfect. Thank you, Daniela. We're gonna be indifferent. Literally, I don't care, we're indifferent, you know? It doesn't matter. But then what happens if we're getting 5% with the company, but the average market rate is 3%? Would we rather the company Thank you. Would we rather the company or would we rather the market? In this case, we would rather, you said happy, but what does that mean? Do we rather the company or the market? Perfect, thank you. Rather the company. Or in this case, the government, who cares? And then what happens if it's 60K in the market and 50K at the company? What would we rather? We would rather the market. Okay, cool. Okay, so now we see something really cool. Okay. So now we understand something really, really cool. So we have that. So now we're going to literally define what this means. So we all said before that this means it's at par, right? Whoops, sorry about that. Sorry about that. Okay. Now, in a world where I think we could all understand that there can't be an infinite amount of bonds that are issued, right? Because if they're all $1 million worth of debts or like loan, you obviously can't have like $1 billion worth of loans. That wouldn't make sense. You can't have $1 trillion worth of loans. That doesn't make sense. So let's say that the company only has a specific 10, like finite amount. We'll call it 10 bonds are available from the company. And there are 9,000 bonds available in the market. So essentially, there are only 10 opportunities for you to either make better, equal, or less than the market. All right. So in the case that there are only like a small amount of bonds available by the company, and the market's giving you literally $20,000 less for each payment, people are going to rather the company, right? And because they're going to rather the company, and because they know that there's only a small amount of bonds available from this company, they're going to be willing to pay what are they going to be willing to pay? A premium. You killed it, Daniela. Exactly, right? They're going to be willing to pay a premium on the bond, right? And I'm just going to take 2 seconds to explain that. We know that there's only a specific amount of bonds available. We know that this bond is giving you way more than the market. So you want that. You want to be better than the market. So you're going to be willing to pay a premium. The public will be willing to pay a premium. So now let's look at the other scenario. If the company is paying less than the market, and you're like, you know what, whatever, I'm down to pay for it. I'm down to get this bond, but will you be paying the same amount, less or more? What would you do? Like if you know they're going to give you less money, right? In comparison to the market, what are you going to pay? A premium, a discount, the same amount? What are you going to do? It's paying you way less. Exactly. Discount on the bond. So these things are extremely, extremely, extremely important. Now, a few things that I'd like to describe just before we go into like a little 5-minute break and we hop in a question is just a few like really important descriptions. All right. So we're going to look at from the POV of the bond issuer, i.e. the company. So we're going to look at a little table really quickly. I'm going to look at an account. We're going to look at debit or credit, then just an explanation. I'm just going to make a little table for you guys such that when you study and you do practice problems other than today, you will have a bunch of little definitions that you could follow through. It's going to be pretty important. So just a few pointers. By the way, my notes, when I'm going to send it to you guys right after this, they're going to be a little bit cleaner. Right now, I'm just trying to like convey a few points. Leave it like that. So really quickly, we know that we're probably going to look at cash. That's probably going to be an account that we're going to look at. Okay. Cash will probably be an account that we're going to look at. And by the way, because we know that, and by the way, we're looking at this from the perspective of the bond issuer. So we're looking at it from this perspective, right? This person, which is a company, institution, and government, right? That's going to raise some money today for future interest payments, and they're going to repay the money they've raised in the future through a full payment and interest payments. All right. So we have for sure the account cash. We for sure have the account bond payable, which is the long-term loan. Cash raised today. And then we're also going to have what we call a premium or a discount. So really important stuff. Okay, so really quickly, I'm going to ask you guys super quick. Just tell me if we're looking at it from the perspective of the government or the bond issuer, cash, will that be debited or credited? Perfect, amazing. What about the bond payable? Will that be a debit or a credit to the company? I only see one answer. It could be right, it could be wrong. I need to see two more answers. Two more answers, just because this is important. So Leandra and Daniela answered. I need to see two more, like maybe perhaps Usain, Arish, anybody. I need to see two more answers. A bond payable from the perspective of the company. Is that a debit or a credit? Leandra and Daniela said credit. Are they correct or are they wrong? Or like, do you have another perspective? Okay, thank you so much. Yes, it's a credit. The reason why this is a credit, it's like with accounts payable, right? It's like with anything else. It's debt, right? It's an obligation, right? It's a long-term obligation. So now let's look at it from the perspective of a discount and or a premium. Let's start with the premium. Is a premium a debit or a credit? What do y'all think? A debit or a credit? What would a premium be? And how would a premium even manifest itself? Okay, let's do this. If we have a premium, okay, we know that if we just go back, let's say that our face value is $1 million, right? So we're ready to give somebody $1 million if they give us money today. We're going to give them $1 million in the future, in like 10 years, but we need to raise that money today, right? We're okay with that. But how would that premium manifest itself? Does that mean that the public will pay us more? Yeah, that's what we said. They're going to pay us more money. So if they're paying us more money, does that mean we receive more cash? Yes or no? Does that mean we're receiving more cash? Yes or no? Quick yes or no in the chat. Yeah, so if a company, if the company is getting a bond that is issued at a premium because people want it, essentially, this means that they're going to be receiving more cash. But the thing is cash is already debited. But we're going to have an excess. We're going to have a premium. We're going to have something that goes above, right? That thing that goes above is what we're going to call and what we're going to look at as being like profit, like income or revenue. And what do we do to income, revenue, and profit when we do a journal entry? When it's going up, when we're adding income, when we're adding revenue, what do? Do we debit it or do we credit it? Income, like revenue. When we're adding revenue, when we're adding earnings, what do? Do we debit it or do we credit it? Remember when we did our journal entries? Exactly. So we credit income, revenue, etc. So a premium, we need to look at it as being a income. We need to look at it as being revenue. And that's why we credit a premium akin to income, revenue. All right. Now, conversely, if we're going to credit a premium, what are we going to do to a discount? I need to see two more answers. What are we going to do to a discount? If credit premium, what do we do to discount? Nice. Inverse premium. Okay, good stuff. So what we're going to do now is we're going to take a 5-minute break because I did talk a lot. I didn't think it was going to take 15 minutes. And then we're going to hop into the first question. All right. And we're going to break it down together. And we're for sure going to do all three. Okay. So let's take a quick 5-minute break. Let's breathe. Let's relax. And we're going to jump straight into it. And we're going to act on it together. And we're going to make it super fun. All right. So quick 5-minute break. We'll be back at 5:58. All right. Are we excited or what? Huh? Where's the excitement? I like to have fun with it. So we're going to have fun with it. Now, just to make sure, does everybody have this question? It's in what I've added to the chat. It's also something that I've sent out before the session. Does everybody have this problem that we're looking at right now? Perfect. Thank you. I appreciate la réponse. Amazing. So this is where everything kind of starts sticking together. By the way, I totally know that we spent a lot of time talking about stuff that isn't so concrete or tangible. And sometimes that could definitely seem kind of annoying, right? Because it's like, hey, let's do a question. But I definitely do think that's going to serve as a good start for this like little boot camp that we're doing. So what we're going to do together is we're just going to read the question. We're going to try to make sense of it. And we're going to highlight a few pieces that may be relevant. And then we're going to try to like go through how I break down these questions. A few things I'd like to say. It's not in the chat. I'm going to do, okay, sorry about that. So check this out. Let me know if you are able to see this, my friend. All right, so I added it to the chat again. Maybe I sent it wrong. Hold up. There you go. All right, I'm gonna do. You should have it by now because it's in the chat. Check it out. If not, just send me a text like you did, and I have the phone right in front of me, so it should be good. Okay, so let's look at this together. Let's make sense of this. So we have this problem 1, which is accounting for bonds, and on March 1st, 2013. What I like to do for questions, I always like highlighting the days. So for me, I'm already going to highlight this date. For me, that's important information. The Office Inc. issued a bond with a face value of $1 million. For me, that's also pretty important. The bond will mature on March 1st, 2023. That seems pretty important. And the coupon rate is 8%. And we know that interest payments will be paid semi-annually. So this is important. Interest payments will be paid semi-annually, starting from September 1st, 2013. Okay, cool. The Office Inc. uses the effective interest method to amortize bond discount or premium. So just note that we're going to have to amortize bond discount or premiums. Now, at the time of issuance, the market rate was 6% for similar bonds. Remember this idea of the market rate? 6% for similar bonds. One thing to note is that the fiscal year ends on March 31st. So what does this mean? It means that on average, like typically, companies end on December 31st. Well, not this one. This one's weird. They end on a different time. So prepare the journal entry to record the bond issuance is our first requirement. So prepare the journal entry to record the bond issuance. So with that, I think we have all the relevant information, right? There's nothing else that could actually like happen in this text, right? We read through everything. So that's the first step. The first absolute step to solving one of these problems is to be able to highlight these pieces, all right? So that's really important. Now, what I'm going to do really quickly is I'm just going to do this right here. And then we're going to hop into solving the first requirement. Perfect. Okay, so what I'd like to do is I'd like to maybe highlight some relevant pieces of information. Right? I know we already did that, but we're really going to spend a little bit more time on just highlighting these different elements. And I'm going to ask you really quickly, like, hey, what do you think? So we're going to have. So in terms of relevant information, what I like to highlight is the date of issuance. The reason why we were going to highlight the date of issuance is because that's literally going to be our first journal entry, right? In the journal entry, they asked us to record the bond issuance such that, by definition, we need to know, well, hey, what is the date of issuance? Because that will literally be an integral part to our journal entry. So we know our date of issuance. We know that our first payment, maybe just do like that. So we know our date of issuance. We know the date of our first payment. Let me just change it like Cool. So we have our relevant information. We have our first payment. So if I ask somebody in the chat, what's the date of issuance? Just to make this interactive, what's our date of issuance? March 31st. Thank you. So March 1st, 2013, and our first payment, well, when will that be? When is our first payment? When is our first payment in the text? When did they say that happened? In 6 months. And what date is that? Just to be super annoying. What date is that? September, exactly. Oops. Perfect. Cool. So once again, so date of issuance, first payment date. So we have September 1st, 2013, and then we have March 1st, 2013. Cool. Okay, and when is the year end? When is the year end? Just to be once again annoying, we know it's March 31st, 2013, and we know that when will this bond mature? When will that be? Somebody tell me in the chat, please. When will that be? When will the bond mature? If you guys, we could go back right here. When will the bond mature? And how much time? Perfect, thank you. So time to maturity. We have 10 as our time to maturity. Cool. So 10 as a time to maturity. Now let me ask y'all, how many payments do we have in a year? How many payments do we have in a year? Nice, cool. So number of payments. Cool. So we have 2 payments per year. Now let me ask you another question. So what will be our total number of payments throughout this bond? What will be our total number of payments within the life of this bond? Exactly. Thank you. This is crucial. Amazing. They're doing great. So our total number of payments will be 20. I guess we'll put it as a number as well. Okay, what else do we need? We know that. We're going to add a few different things as well. What's our face value? Just again, to be super annoying, what's our face value? Nice. Cool. And then our coupon rate, what is that? And what is our market rate? What is our coupon rate and what is our market rate? Somebody tell me. What is our coupon rate? What's our market rate? I'll go back right here. Sorry about that. Coupon rate and market rate. What are those things? Nice. And what about the coupon rate? Nice. Cool. Thank you so much. So why am I doing this and why am I taking the time to identify these topics? All right. Why am I taking the time to identify these key points? The reason is because on an exam, and this is me who I've probably taught this class for about 8 semesters now. And even me to this day, when I start a question like this, I want to have all the information I need identified in front of me, because this will help me reduce my errors in the future. And like that, everything is highlighted. And realistically, this is all you need to succeed on this question. Okay, this is literally all you need. All right. So that said, I'm just gonna add a few caveats at like the bottom here. They're pretty relevant, and like that, we won't have to spend too much time on it later. All right. So let me ask you this: if our face value is $1 million and our coupon rate is 8%, what would be our payment per year? What would be the total value of the payments we've done in a year? Can somebody tell me that? What would be the total value of a payment in a year, right? Like if our face value is this and the coupon rate is this, what would be the total payment for the year? Somebody write that in the chat or something. If this is our face value and this is the coupon rate, what is the annuity payment? Okay, so Leandra said 80K. So that's going to be how much money? There you go. Thank you, Amadou. Exactly. So it's 80K for the entire year, but that entire year is divided by 2 payments per year, such that we're going to have 40K per payment. Is everybody in the chat okay with that? We're going to have 40K per payment, right? This times this divided by this, which is going to give us 40K per payment. So are we okay with this specific idea? I need 4 people to say yes. I just want to see yes really quickly. Okay, cool. So can I ask you this? Would we get 40K even if we just did 1,000,000 times 4%? Would that be true if we just did 1,000,000 times 4%? Right? Like if we just did this, whoops, if we just did this divided by, we would have 4%. And if we did 4% times 1,000,000, we would get the same amount. Is everybody okay with that? That 4% times 1,000,000 will give us 40K, and 1,000,000 times 8% divided by the 2 payments per year would give us 40K. Are we on the same page? I think the answer is yes. Okay, cool. So what I would like you to remember is that our coupon rate per period, okay? Our coupon rate per period, okay? Really important. Our coupon rate per period will be 4%, okay? Our coupon rate per period will be 4%. And by definition, our market rate per period would be equal to how much? Can somebody write that in the chat? Our market rate per period would be equal to how much? 3, nice. Now for now, that's not totally relevant, but I just need you to remember that because we're going to use that in the future. Okay. So now we have all the different topics we need, okay? We have all the different things we need. I'm going to ask you another question. If you paid attention earlier, right? If you paid attention earlier, if we know that our coupon rate is 8% and the market rate is 6%, what type of scenario do we have? Is it at par, premium, or discount? I need to see a few other answers in the chat, just a few. Okay, one more, just for fun. I know you saw the answer, but one more, just for fun. What is this? It's a premium. So we're for sure going to have a premium on the bond issuance. So when we have a premium on the bond issuance, that means that our cash, we could write received today, will be bigger than our bond payable, the debt we owe. Does that make sense? Do we all understand that the cash we're going to receive today will be bigger than the bond payable, i.e. the debt we owe? Are we all on the same page? Okay, cool. So now that we understand all these different pieces, right? We looked at the question, okay? We looked at the question, and now we've highlighted some pieces. We know that now we need to find the journal entry for the bond issuance. We've put back down all the different things we've highlighted, and we know that we have a premium on bond issuance and that the cash we're going to receive today is going to be bigger than the debt we owe. So now that we know that the cash is going to be bigger than the debt we owe, how do we find that cash? Where do we find it? That's a hard question, right? How do we find what the market is ready to spend on our bond? We know they're ready. We know that we're giving them better, so they're going to be willing to pay more. But how do we figure that out? How do we find that specific value that the market will be ready to spend on our bond? Does somebody have an idea in the chat? How do we do that? How do we do that? What methodology do we need to use here? What methodology do we need to use here? Right? How do we do that? Does somebody have an idea? You could even raise your voice, you could write it in the chat. Anything's good. Now we have a problem. How do we find problem for requirement 1? How do we find the present value of our bond? In other words, what does the market believe our bond is worth. In other words, how much cash is the public ready to spend? I.e., what do you think, Daniela?
Do we just multiply the million by 6% and do the difference between what we would receive with the coupon rate?
So that would be a very logical way of doing it. That would be a very logical way of doing it. Now, the only thing for the reason why that's not the best practice here is because some of those coupon payments, right, that we know we're going to get are going to be received in the future, right? Some of these coupon payments that we know we're going to get are going to be received in the future. And the thing is, because they're going to be received in the future, that means that we're not going to get our money back today. Does that make sense? Do we all understand that that money that we gave to the government will not be received today? So how do we make sense of that? How do we solve for this problem? And what I'd like to do is maybe draw a little timeline such that it could give you all a better idea of what we're looking at here. And this is going to be the reason why we use this thing called the present value table. Okay? So this will be today. And I know I suck at drawing, but you could bear with me. And this will be, we said what, 2013, and the bond issuance is 2013, so the year end. So this will mature at 2023, right? So far, do we all understand that this is what's going to happen, right? So today, and we have the future. Okay, so this is interesting. If we look at it from the perspective of the company, right? Let's look at it from the perspective of the company. The company is going to get, in this case, I believe it was $1 million, right? Yeah, the bond is $1 million. So for every single bond, the company will receive $1 million today. So it's going to be plus 1 million, right? But in 10 years, they're going to have to give that $1 million back. Does that make sense? Are we all on the same page? Okay. So, but are we missing something? Is there something else that the company is going to have to give out every single year? Of course there is. The interest payments. So they're going to have 1, 2, 3, 4, 5, 6, 7, 8, 9, and then 10 interest payments. Well, they're going to have 20 interest payments, but we're going to just say like 10 years to make this easier for us. They're going to have 80K that they're going to need to spend every single year, right? 80K every single year. It's a lot of money. And these are all negatives, right? Do we understand that idea? That they're going to have to spend 80K every single year, plus the loss that they're going to have to spend in 10 years. So in exchange of their $1 million, right, that they're receiving today, they're going to have to do a bunch of future payments in the future. I think we all understand that. So this is a future payment, the future payment, future payment. So the thing is, though, from the perspective of the public, the person who bought it, they need to wait 1 year to get their first $80,000. Then they need to wait another year to get their first $80,000. Then they need to wait another year to get the next $80,000. And then to get their $1 million that they spent today, they need to wait all the way to 2023. So they're not getting that whole value in one shot. Does that make sense? Are we all on the same page? They need to wait to receive their money back. Are we on the same page? Yeah? Cool. Like, just to be super annoying, what I'd like to say here is that from the perspective of this person, their investment looks like this: minus $1 million, then plus $80,000, then plus, once again, $80,000, all the way to 2023, in which they're going to get $1 million back. So it takes a lot of money, a lot of time for them to get their money back, right? Because they're taking a loss today. So now we need to look at it from the perspective of the public, the person, the bondholder, right? I think we could all agree if I did the test right now with you guys, would you rather $500,000 today, or would you rather $1 million in 50 years? Which one would you take? $500K today or $50 billion in, oh, no, that's not a good one. $500K today or $1 million in 50 years. Which one do you take? Can somebody answer in the chat? Oh, good for you, Alexander. You are a very sage person. But realistically, it is for sure a debate, but a lot of people will choose money today rather than money tomorrow, right? Let's even break down an example even better. Like, let's say 500 grand today or 600 grand in 10 years. Which one do you take? I think most of us will say 500K because we're going to work, we're going to, grind, whatever. We're going to be able to make that 100K within those years, right? So the idea right now, what I'm trying to say is that money today is better than money tomorrow. Can we all agree to that? Yes or no in the chat really quick. Money today is better than money tomorrow. Cool. So this leads us to this idea of time value of money. Because money today is more valuable than money tomorrow, the money tomorrow it loses value, it depreciates, right? Because a lot of you said that 500K today is better than $1 million in 50 years. So for you, at the very minimal point, 500K today is equal to $1 million in 50 years. So you're literally saying 500 grand is equal to $1 million, just in different timelines. That's a pretty crazy idea. And that's exactly how we're going to try to find the value of the total payments this person will get over the lifetime of the bond. Because we know 80K in a year is not as great as 80K today, we need to find what that 80K is actually worth. And we're going to do the same thing at every single one of those 80Ks, right? Then we're going to do the same thing at the $1 million in 10 years. Because maybe $1 million in 10 years is equal to only 500 grand. Does that make sense to y'all? Do we see that we now need to find the present value of these future payments? Are we all on the same page? Amazing. By the way, this will be super helpful for Comp 308, by the way. Like, this is literally the first 2 exams, so helping you out already. So that said, in order for us to solve this problem, how do we find the present value of our bond? In other words, what does the market believe our bond is worth? In other words, how much cash is the public ready to spend? We need to use what we call an annuity table. We'll call it an annuity table because we're weirdos. We kind of like that. So we're going to call this an annuity table. So, and then after this becomes really easy, because once we've identified these steps, and these are the steps we're going to use for every single question, you'll literally know how to do these questions in a second. So I can even call this present value calculation. And to do so, we're going to do this. All right. Okay, so what we have here now is a little table. Realistically, on an exam, you do not need to do it like this. It's really pas obligatoire. You don't need to do that. But, it's common practice, especially when we had like Excel, right? When we had to do it through Excel. So I'm just trying to make it look a little bit nicer such that you don't feel, lost at any time and point. So, okay. So could somebody tell me what would the principal be? What would that mean? What is a principal? What would that be like with all the information we looked at? What would be the principal? Like if you'd have to think. Exactly. So the principal is what we call face value. Principal is literally the face value. It's the value of the bond. Okay, that's literally all there is to it. The principal is literally $1 million. Okay, so by the way, before we go on to the next step, are we all okay with the idea of principal? And are we all okay with this idea of like present value of money, right? How we need to figure out what's the present value of all these future cash flows. Are we okay with that? Like if anybody has a no, it's really now the time to do so because the two other problems are going to be super quick and easy for us. So are we all yes right now? Like, are we all okay? I need to see a few yeses. Cool. All right, I'm gonna assume this is a yes. So that said, now what I'd like to say is we're gonna go back to our actual timeline just to really make sense of this the right way. So if we know this is our timeline, okay, and we know this is T for today, this will be 6 months after. This will be 12 months after, so a year in. So this would be like 2014. Could you tell me how much money is he getting here? The public, the bondholder, how much money are they getting in here? What is the amount that they're getting here? What is the specific annuity payment that they're getting?
80,000.
Okay, so yeah, this is 6 months though, and this is 12 months. So this is after a year. How much are they getting per specific payment?
40,000.
Exactly. So when we do this little calculation, what I want you to remember, okay, is I really need you to remember that an annuity payment is literally the specific dollar that you're getting for the specific payment. In this case, we know that we're looking at 20 specific payments, right? And those 20 specific payments are of $40,000. They're not of $80,000, right? It would be a big difference because if it was 80K twice per year, that means in a year they're making 160K. That means that this would have been 16%, right? It would be different. So that's why it's important to remember that. So what would I put here just to be sure? What is the value I put here to be super annoying? Somebody just write in the chat quick, like what would that value be? What would, if you'd have to guess? There's no wrong answer. Literally, you're allowed to make mistakes here. This is the place where you want to make mistakes, by the way. So what would I write in my value here? Thank you, Leandra. Yes, 40K. Because what we're trying to see here is we're going to try to evaluate what is the present value. What is this money worth today? This is what we're trying to do. We're trying to evaluate what these specific values will be worth today. Okay, that's what we're trying to do. This is really important. So we're trying to figure out what these two values will be worth today. So the reason why this is important is because we know that this $1 million, we're only going to receive it how many times within the maturity of the bond? How many times are we going to receive $1 million? How much time does the public? One. Okay, amazing. Now, the public, how many times will they receive 40K? 10 times, 20 times, 30 times? How many times?
20 times.
Exactly. Amazing. So remember that. We're going to write that. So we're going to write 1 here, and we're going to write 20 times here. Okay. And honestly, this is all that matters, so 20 times. So now this leads us to the fun part. How do we find the present value multiple? Like how do we find this multiple? Like what is it? What is the number or thing that we're going to use, the magic tool we're going to use to do so? And the magic tool we're going to use to figure out the present value multiple will be the following. All right, and I'm going to show you exactly how to use it. How do you find the present value multiple? And you find it by using this little table here. So let me just align myself. So has anybody in the chat seen this table before? Yes or no, quickly. Daniela says yes. Anybody else? You could say no as well. Like there's no wrong answer. It's totally fine. Okay, cool. So what this table is all about, it's essentially a present value table. This table will allow us to find the multiple we're going to apply to the principal or the annuity payments to find their present value. In other words, their value today. Remember, We said before that 500K today would be more worth it to us than $1 million in 50 years. So this table wants to help us in that path into finding the present value of a specific one single payment and also the present value of a payment that will happen again and again. So what I'm trying to say here is that this specific table, table A1, I guess we'll put it like this. Table A1 is looking at the principal, okay? It's looking at the principal. All right, so now what I'd like to also share is that, can we notice that on the columns, we have a bunch of different percentages? Can everybody in the chat say yes? On the columns, we see a bunch of different percentages. Can we all agree? Like, perfect, amazing. And then on the rows, we see a bunch of different, periods, right? In other words, we see a bunch of different number of periods, right? Can somebody tell me where we find our amount of periods? Is it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, or 20? How much is it? How many periods do we have in our section? How many payments do we have? Let me ask you that. How many payments do we have? How many payments are going to happen? Nice, amazing. So what I want you to remember is that this will be the number of payments, okay? Really, really, really important. The number of payments that are going to be done by the government. Let's use the government, okay? So now the last point I would like to iterate here is, so let's think about it. By the way, from which perspective are we looking at? Like, who are we trying to consider right now, right? Who are we trying to consider? Are we trying to consider the market, or are we trying to consider the company, right? Who is trying to find the present value? Who's trying to understand how much money they need to spend? Who? The public or the government in this case? If you'd have to think about it. Who will benefit from this present? Like, who needs to actually use this present value table to figure out how much money they're willing to spend? Is it the government or is it the public? Exactly. So the public is part of the market. Do we all understand that? Like, the public is part of the market. Yes or no? Hell yeah, exactly. The public is part of the market. And because the public is part of the market, we're going to use the market rate. Does that make sense? Because we want to figure out what the public is ready to spend, and because the public is part of the market, we're going to use the market percentage, i.e. the market rate. Are we all okay with this idea that this represents the market rate? Can I see a yes in the chat or a no in the chat? Okay, amazing. So, okay, Daniela, amazing. Can you ask like your question, if you don't mind, if you're okay with that?
Could you just repeat why it's the market rate? Just the last two sentences you said.
Yeah, no problem. So let's actually go from the very beginning. We know that money, right, is worth more today than tomorrow. And this person here, the public, wants to figure out what is all these different cash flows, the 80Ks all the way to the $1 million in 10 years will be worth to them, right? We want to figure that out. The public wants to know how much is all of those different cash flows, those different money payments that they're going to get worth to them. They want to know how much is that worth today, right? And in order to do so, they want to find the present value of those cash flows. And because the public is part of the market, right? The public is the market. They're not the company. The public is literally part of the market. They're going to use the market rate. They're going to use the public, like the public's rate, to find the present value, right? They're going to use not the coupon rate, but they're going to use the average. They're going to use the market sentiment, the market rate, to figure out what's the present value of their of the future payments they're going to receive. So let me say this one more time. We're looking at this from the perspective of a client, of a person, and the person is part of the market, and the market has a specific rate, Like that's what the market typically gives. So they're going to use the market rate to figure out what they would be willing to pay on average for a bond that has the same set of cash flows. Does that make sense? Does that give you a better perspective? Okay, cool. So we know that there's 20 periods, right? So we know that these payments are done twice per year. So which percentage are we going to use here? Are we going to use 2%, 3%, 4%, 6%, 8%? I need to see 3 answers at least in the chat. And then I'll tell you which one we use. Leandra says 3%. Alexander says 6%. Hamid said, Amadou says 6%. I need one more just for fun. Alexander says 6% again. Okay. So what I'd like to tell y'all is that, yes, exactly. By the way, every time the recording will be sent in our group. So don't worry, you could leave whenever you want. I know it's a long session, no worries. The recording will be sent in our group, okay? So that said, the answer here is actually 3%. But what I'm happy to see is that all of you knew that we had to use the market rate. That's amazing. You already did like 90% of the job. But we need to use the market rate for a single period. And because there are 20 periods, right? There are 20 periods because we are literally like doubling, like we're doing 2 payments per year. And we know that those 2 payments per year will be equal to the rate divided by 2. Let me give you like more, because I'm kind of talking in the air. Remember how we said we could apply 4% and we'd get the same like effective payment? Well, the same idea is being applied to the market rate, right? Oh, by the way, Amadou, they're always going to give you the table. Always, you will have the table. The only thing you want to understand, and I'll explain it a little bit further, but you always need to use the table they give you. So don't worry. Like you don't need to go find one. They're always going to give you the table for this question. All right. So for Amadou, Alexander, and others who maybe didn't like try this question or like that didn't put in the chat, sorry. What I'd like to tell you is that because we know there are 2 payments per year, right? And because we know there are 2 payments per year, we could literally just divide the coupon rate by 2 and we'd find the payment for one single period, right? So because we know we're looking at 20 periods, we need to look at the rate divided by 2. Like, does that make sense? Am I not being clear? I just want to be sure. Does that make sense? Like, what do y'all think? Yeah. So like, do y'all understand why we can't use 6%? Because if we use 6%, it's like you telling me that the market rate is equal to 12% for a year, right? Because there are 2 payments per year in this case. Because there are 2 payments per year, it's like if we did 3% for one payment plus 3% for another payment, and that's going to give us 6% for the entire year. Does that make sense? That's why we're using 3%. Are we good? If anything, you're going to have a second opportunity to try this, so it's not a problem. So that said, what would be the multiplier we're going to use here? What would that number be? Somebody could write it in the chat. It's the intersection of 3% and 20 periods. What would the multiplier be? Can somebody write it in the chat? What would that multiplier be? Thank you so much. You killed it. Cool. So I'd like to share a few things about this, though. I'd like to share a few things. Do you notice how this number is smaller than 1? Do you notice that this number is smaller than 1? Yeah? So this number is smaller than 1. And here's why this matters. So if we do the product of these two, we're going to get a value that is going to be smaller than our initial value. Do we understand that this value is smaller than this value? Yes or no? Yeah, this value is smaller than this value. And the reason why it's smaller than this value is because it's like what we said before. $1 million in 10 years is not worth the same today. And that's why the multiple that we're applying is way smaller than 1. Because we understand that that $1 million, if we use the market rate with the number of periods we're looking at, it has to be worth way less today. For this person, $1 million in 10 years is only equal to $550,000 today. Does that make sense? Do we understand why that multiple is like smaller than 1? Yes or no? Right? Because that one specific payment of $1 million in 10 years, well, it's only really worth half today. Okay? So then, with that in mind, let's try to reallocate this perspective now to the second table, which is the present value of annuities. They will tell you that this is for an annuity, but generally the first table is for the principal, the face value, and the second table is for the annuities, okay? So can you tell me what column are we going to use? Which one do we want to identify? Which column are we going to use? 2, 3, 4, 5, 6, 7, 8. Which one are we using? No answer is wrong, by the way. Which one are we using? Which column are we going to use? Which one are we using? Any answers? Well done, Olivia and Alexander. Yes, we're going to use, once again, 3% because we're looking at the market rate. We're trying to figure out what's the value of those annuities. What's the value of all those little $40,000 that we're going to get? That's what we're trying to figure out. And that's why we're going to apply 3% and 20 periods. We're doing the same thing as in the previous table. It's the same idea. And for that reason, we're going to allocate this figure right here. Does that make sense? Do we understand why we did the same thing? Is that clear, Leandra? Does that make sense? Okay, cool. So amazing. Good. So 14. Good stuff. So we have that. Okay. But now let's go back to the same idea. Do we understand why this value is bigger than 1? Why is it? Can somebody tell me concretely, why is this value bigger than 1? Because this one was smaller than 1. It was giving us a value that would be smaller than $1 million. But in this case, Amadou, I love it. Yes, you killed it. Because we have more than 1 payment. So for sure, we're going to discount those future payments, but we have literally 20 of them. So this is really, really dope. Because naturally, what you would do is that if you knew that we had $40,000 that's going to be paid out to us 20 times, it should be worth $800,000, right? Do we all understand that this should be 800K? If we know that we're getting this 20 times. Remember this? 20 times? Can I see a yes or a no? If we know annuity payments of $40,000 are expected to be received 20 times, 40 times 20 gives us 800K. But in this case, this is only giving us $595,000 and $595,100. This, whoops, this and this are definitely not the same values. In fact, what we did here is that instead of multiplying it by 20 periods, we only multiplied it by like almost 15 periods, right? That's how much our money is worth today. It's only worth 14 periods of payments rather than 20. Does that make sense? Does that make sense? Like, are we okay with that idea? Yeah, sure, no problem. So is everybody here okay with French? because sometimes I like to go with French and English, like here and there. Like, do we understand French? Are we cool with that? Like, does anybody have a problem with French? Amadou, are you okay? Yeah, Amadou, I know you're good with French, actually. So, qu'est-ce qu'on a ici, c'est que on sait que typiquement, on aurait 20 paiements, right? 20 paiements de 40 000 $. C'est ça ce que le gouvernement va faire. Par contre, on sait que le paiement, c'est différents paiements que le client va recevoir. Ouais, cette personne, ça va être 80 000, 80 000, 80 000, blablabla, jusqu'à 1 million de dollars en 2023. Cependant, on sait que l'argent aujourd'hui est beaucoup plus important que l'argent qu'on va recevoir demain. Et de cette manière, pour ce client, pour cette personne spécifique, ces 20 paiements qu'il allait recevoir, qu'il allait cumuler à environ 800 000 $, ne vaut que 595 000 $. Parce que le paiement qu'il va recevoir en 2022, c'est beaucoup trop loin pour lui. Ça n'a pas la même valeur que le paiement qu'il allait recevoir, soi-disant, aujourd'hui. Puis de cette manière, c'est comme si on disait que le present value n'est qu'équivalent à 14 périodes ou presque 15 périodes au lieu de 20 périodes de paiement. Et c'est pour ça que la valeur qu'on a ici est beaucoup plus petite que la valeur des 800 000 $ qu'on était supposé d'avoir. Does that make sense, Leandra? We were supposed to get something, but because it's so far in the future, it's not worth as much. Okay? So now all that is left to do is to sum these two values together. And that's going to give us the following. So can somebody tell me, what is this value equal to? What is this worth? What is this value? If we have to like full circle. Olivier says cash received. Now, Olivier could be right. He could be, but I need to have at least one other person to answer for me to confirm. So what does this mean? What does this value mean? Maybe Olivier is correct. I don't know. What does this value mean? Amazing, Daniela. So if this is what the bond is worth today, how much cash are you going to receive today? If that's how much the bond is worth, how much cash will you receive? The same amount, more or less? What do you think? Exactly. Amazing. So Olivier and Daniela, you guys nailed it. All right. So now we have all these different pieces of information. We love it. We're happy. So now the only thing that we need to do is create our journal entry. So our journal entry on March 1st, 2013, i.e. date of issuance. Oops. Will look as follows. And what I'm going to do is I'm going to test y'all. I would like to see what you think this would look like. What do you think our journal entry would look like? Can somebody tell me? What do you think that would look like? What would that look like? Okay, so we see cash as a debit. I'm cool with that. Okay, Olivier's on a roll. I'm not going to lie. Olivier's on some sort of crazy roll. I'm loving it. Do people agree with Olivier? Does that sound like an okay statement? Does that sound like an okay journal entry? Yeah, exactly, Leandra. Sorry. From the perspective of the issuer, yes, for sure. All the requirements are from the perspective of the issuer. Sorry about that. Yeah. So how much cash will the issuer receive and how will their journal entries actually look like afterwards? Okay, well, anyways, yeah, Olivier, you're all right. So Olivier, what would be the cash that we're getting? What would that be? What would the cash be? I mean, you already said the answer before, so I won't probe you too much. Okay, and then bond payable, which is a credit. And then we're gonna have our premium on bond. Okay, so what is our bond payable? What would that be equal to? What is our bond payable? I need two people to answer at least. What is our bond payable? Olivier says $1 million. That could be true. I don't know. It could be. Whoa. Does somebody else have an answer? What about Amadou? What do you think? What do you think our bond payable will be equal to? What do you think? By the way, if you guys don't want me to like call you up, just let me know. But thank you, Amadou. Yes. So Amadou, Alexander, Olivier, totally right. Yes. Our bond payable is equal to $1 million. So let me just do this. So $1 million. And the reason why it's equal to $1 million is because, listen, it's like, let's say you told somebody, hey, my loan, like what I'm ready to give you is $1 million. That's what the company's saying to the public. I'm gonna give you $1 million in 10 years, okay? But what you're willing to pay me today, that's up to you. If you want to give me $1 billion, that's up to you, but that's not going to change the fact that I'm only giving you $1 million, okay? So that's why bond payable, and this is an important rule, bond payable at the date of issuance will always be equal to the face value. There is never a scenario in which the bond payable on the date of issuance is not equal to the face value, right? And it will always be credited. This is a free like 4 points on your exam. Always the case, okay? So now, in order to make this balance, what would be our premium on bond payable? What would that amount be? If somebody could tell me. What would be our premium on bond payable? Well, thank you so much, Nila. There you go. You killed it. Yes. So that is what our journal entry would look like. So before we proceed, do we have any questions about the first requirement? Do we have any question about the first requirement? Oops. Are we all okay with this? Just say yes if you're cool with this. That's fine. Cool. Okay. So now let's hop.
Oh, sorry.
Yeah, sorry.
Is this the journal entry that we do always as in the day of issuance?
Yeah. So on a date of issuance, this will always look like your journal entry if it's a premium. Okay. Obviously, if it's a discount, it'll be a little bit different. You're just going to have a discount as a debit. But yes, this will always be how your journal entry will look like. Okay. So I think that's the good stuff. Now let's try to make sense of the second requirement. Let's try to make sense of the second requirement. All right, the second requirement says, show the liabilities section of the Office Inc. as of March 31st, 2013. So this is some pretty interesting stuff because it's asking us like a few things, okay? And on an exam and on the practice problems that we have, you always want to like look at it from a bucket to bucket perspective. We try to break it down into easy steps, right? Like, here's our problem, and maybe we could break it down into buckets to make it easier for us. Like, hey, this is one bucket, another bucket, third bucket, and we go one by one. Once we finish one bucket, we go to the other one, and so on. And that should help us solve the problem, okay? So in this case, what we want, first and foremost, is we want to look at March 31st, 2013. So how much time has passed since the date of issuance? Can somebody tell me? How much time has passed, right? How much time has passed since the date of issuance? Since our first journal entry, right? Since the first requirement, how much time has passed? We're looking at a different time. So how much time has passed? Like literally from March 1st to March 31st.
31 days.
Exactly, 1 month. Let's go at 1 month. 1 month has passed. Amazing. Thank you. So 1 month has passed. I really think, by the way, and this you'll understand more as you do more like exams and take more classes at Concordia. But when we give you a date, when we give you information, we got to run with it. It's probably valuable. So in this case, the dates we want to be able to find how much time has passed. So in this case, we know, okay, 1 month has passed. Then we're asking you to look at the liabilities section of the company. So we need to make sense of liabilities. For sure, within liabilities, we're guaranteed looking at bond payable because that was something we credited in the past. but we may need to credit a few different things, and that will be able to kind of like define in a few seconds. So that said, what I believe is best practice when you do a question like this, especially when you get to like past the bond issuance date, so past the first requirement, we need to build what we call an amortization schedule. Now, who here has heard of an amortization schedule? Is that the first time we've heard about that? An amortization schedule, a payment schedule of the sorts? Okay, so Olivier, is that okay? Say yes if you've heard about it, say no if you haven't. So I need all of y'all to say, okay, cool. Perfect. So essentially, what I'll say is this, okay? And we're gonna highlight some stuff. We know that we received $148,800 above what we were supposed to get. Do we all understand that we were supposed to get $1 million, yet we received a premium of 148,000 bucks? Are we all okay with that? Just a quick yes in the chat. Amazing. You guys are doing great. So in life, unfortunately, especially in accounting, we need to essentially amortize this premium because the company, when the bond will mature, they would want the premium to be equal to 0. Okay? They would want that to be equal to 0. Why is that the case? Because by doing so, they'll be able to balance their journal entries. Okay? So what you want to understand here, if we go back, is that you want to understand that they want their premium or their discount to be equal to 0, and they want their stuff to balance. Okay? And that's why we need to use an amortization schedule. It's as simple as that. That's all you need to understand. And this happens if and only if there is a premium and or a discount. And in this case, we have a premium, so we need to amortize that. Does that make sense to everybody? Are we okay with that? It's a rule that we need to follow. Are we okay with, we have a premium, and because we have a premium, we want that premium to go to 0, okay? And in order to do so, we need to amortize it by using something that I'll show you. So like, do we just follow those steps? Like, do we understand where we're going with this? Just a quick yes. I'm gonna assume it's a yes. Okay. So in order to do so, we need to use an amortization schedule. So I believe I'm gonna do that. All right. An amortization schedule. And in this amortization schedule, we're gonna have our interest payable. So i.e. our coupon payments. And we're going to have our interest expense, have the difference, then we're going to have our carrying. So what I'm doing here is something that I really do think that even on the exam, you should definitely try to do, because it's like totally best practice. So you want to be able to define something like this. So these are your interest payable, coupon payments, interest expense, blah, blah, blah. So in order to make this simple, we're going to look at this from step by step, okay? Look at this from step by step. Let's look at all the different dates we may want to look at in this question. So what is the first date we've been like shown in this question? What was the first date they showed us? What was the first date that they like displayed, like in the text, like in the question? What was the first date? Yes, thank you. Amazing. I guess amazing. So that was the first date. All right, what is the second date? What happens? What's something that the second requirement asked us to look at? At what time? Yes, nice. Perfect. So we're going to start with this. That's all we need. That's all we need. Perfect. And this again. Gotcha. All right. So on the first date, I think we could all agree that there are no interest payables. We don't need to pay anything, right? We don't need anything. The only thing that we need to look at is we need to look at what we call our carrying amount. Our carrying amount essentially is just the amount of cash we received, okay? That's all you want to remember. These are like rules that I need you to kind of like just internalize, that this is our carrying amount, okay? This is our first part of our table, and this will not even be graded necessarily. It's just really good practice for you to understand what is happening. Okay. So with that said, do we all remember this idea of adjusting entries? Essentially, with an adjusting entry, at the end of an accounting period, we just need to adjust a few accounts. So for example, we would adjust wage payable, we would adjust prepaid rent, rent expense, blah, blah, blah. And in this case, because we know that the year ends at March 31st, right? We just need to do what we call an adjustment for our interest payable. So for our coupon payments, okay? That's something that we're gonna need to do. So how much time has passed from March 1st to March 31st? Can somebody tell me in months? How much time again? A month. Okay, cool, amazing. So how much does the company owe for each period, for each payment period to the bond holder? How much are they paying? What's the annuity payment again? What was that? 40K, right? But only 1 month passed. So how much would they owe them if we had to do an adjusting entry after a month? Can somebody tell me what that amount would be? How much would they owe after a month? How much would they owe after a month? Yo, you killed it, Leandra. Amazing. Yeah, okay. So Leandra did really, really well. And what I'd like to share here is how we're going to get to this answer. So we know that 1 month has passed. So I think we could all agree that one payment looks like 40K. But the thing is, we're not looking at a whole period. We're not looking at 6 months. We're only looking at one portion of that. We're only looking at 1 month of those 6 months. So what you're going to have to do is you're going to have to do 40K times 1/6. And that's going to give you the interest payable, which you owed for that specific month that has passed. Are we okay with that? Does that make sense? Do we have any question about this? Sorry about that. Are we all okay with this? Did we all get to this interest payable amount? Alexander, Olivier, Leandra, yeah? Okay, cool, amazing. By the way, like, don't hesitate to keep your like mic open if you want. Like, we're only like 4 people, like excluding myself, so we could just like talk instead. It'll make it easier. It'll be more like interactive for you as well. So now we've discovered what's an interest payable, essentially what we owe to the bond holder. However, there's this idea of interest expense. And the interest expense would be what you would owe to the bond holder if we used the market rate. And if we used the price they paid for the bond, right? Because for the interest payable, we're gonna, essentially what we did, if we had to look at like a long formula, what we did is we took $1 million, right? We multiplied it by 8%. Then we divided it by 2 because we have 20 periods within a year. And then we times it by 1 times 6, right? That's exactly what we got. Do we understand that that's what we did here? Like, are we okay with that? But the interest expense is, we're just going to do the same thing, where we're going to look at it from the perspective of the market. So the market, what they would be willing to pay was $1,148,800, right? But their market rate, their rate is 6%, right? Divided by 2, because there are 2 payments per year, times 1/6, because we're only looking at 1 month that has passed. And that gives us a different amount. So essentially what I'd like to write here, and I know I said a lot, so it's totally fine if you have a question. What I'd like to say here is that we're going to look at it from the perspective of the company. And here we're looking at from the POV of market. So you notice how here we used the $1 million. Here we used the $1 million, 148,800. Here we used 8%. Here we used 6%. Are we on the same page? Does that make sense? How we got to these two different numbers? Yes or no? Okay, cool. Amazing. This is literally the hardest part of the question. After this, every single question is the same thing. Oh yeah, formula, let me try to write it down. I'll write it down here. So it's gonna be, so cash received times market rate divided, I guess, divided by number of payments per year. And then you may need to prorate it, Leandro. Like for example, if it's only 2 months out of the 6 months, or like 5 months out of the 6 months, or like 2 months out of the 12 months. But this is like the base formula, okay? So the difference here, put this as A, put this as B. Okay. So the difference here, can somebody tell me what the difference would be, just for fun? What would the difference be between these two factors? What would be the difference between these two numbers? Nice, thank you. Merci, Olivier. Donc, la différence entre les deux, c'est 922 et 67. Okay? So that's what you want to understand. So what I'd like to highlight is that if we had to make a journal entry, we had an interest payable of this amount as of March 31st, 2013. Okay? And what was left in our carrying amount was equal to, I guess we could call this, I guess we could just do minus difference. Okay. Such that our, yeah, sorry.
Do you mind just saying the interest expense one more time? The formula that you went through for that?
Yeah, no problem. I'll actually highlight them. So
yeah, thank you.
So what you're going to do is you're going to do cash received, right? So cash received times the market rate divided by the number of payments in a year. And that's going to give you like the total amount. It's going to give you this amount right here. However, this amount, you're going to need to essentially do it times 1.6, right? 1.6, the reason why is because we're looking at only 1 month of that period for that payment. Does that make sense?
Yeah.
Perfect. And that gave us this amount. So that's great. So now we have, by the way, after this, I'm gonna like clean up our Excel into just one Word doc, such that you don't have to like kind of like try to like be worried. It's gonna be simple. So that said, now that we have all this information, we're actually able to build our statement of financial position, the liability section. That's really great stuff. And I'll tell you what we're going to need to add. And it'll really make sense the more we do questions, of course. So merchant center. Merchant center. Okay, so we're going to have a statement. We're going to have it partial. Actually, we're going to call it Office Inc. Statement of financial. Then as of March. All right, so we have this good stuff. That's really cool. Amazing. Cool beans. Okay, so now we're looking at the liability section. And we need to look at two things, the current liabilities subsection, and then the non-current liability section. Sorry about that. I had like a brain fart. So yeah, we have current liabilities, then we have non-current liabilities, and we need to figure out what goes into each. So in current liabilities, what do you think we would add? By the way, when we do questions, we don't do stuff just for fun. So obviously it's from what we just looked at. So what would be a current liability that we may want to include in our statement of financial position? What would we want to use? Okay, Olivier says interest payable. Does somebody second that idea? Amazing. Really, really good insight. Yes, we're looking at interest payable. A quick tip that I'd like to share is that once there's the word payable in an account, it's guaranteed a liability. And most often than not, it'll be a current liability. Okay. So in this case, we have interest payable. Now, what would be our interest payables like value? What would that be if you'd have to guess? What would that be? Would it be this one by any chance? Amazing. Yeah. You killed it. Perfect. And then what would be our non-current liabilities? What would be the most obvious one? What would be the most obvious non-current liability? What would that be? We'd have to guess. What would be the most obvious non-current liability? What would be is interest expense? What is an expense usually? Where does that account go? Olivier, where does that interest expense account go usually? Exactly. Well done. And Leandra, of course, yes. So it'll be the face value. Now, for this like chapter, I would like to call the face value our bond payable, right? So we're going to call it our bond payable. Now, I'd like to ask you, what would be the value of our bond payable? If you remember what we did for the first journal entry, what would be the value for our bond payable? What would that be? What would the value be for our bond payable? Nice, Daniela, you killed it. Really well done. You are all doing very well. So that's good. So 1 million. Okay. Now, what I'd like to make sure that you remember is this little thing that we're going to call a premium on bonds payable. That's something that we must add to our statement of financial position. There's no other way to go about it. We need to add it. So our premium on bonds payable is something that we're going to add. And that's going to give us what we call our carrying amount bonds payable. And these are things I just want you to be able to remember. Okay. They're things that I need you to be able to remember. And it's like something that you're always going to do. So to do this simpler, what would be our carrying amount on bonds payable? Like we have it in our schedule. What would that be? What would that be at March 31st, 2013? What would that be? What would that amount be? Would it be this amount, this amount? Nice, in yellow. Killed it. Perfect. So by definition, what would this be then? What would be our premium on bonds payable at that date? What would this be? What would this number be? If we know this is this and this is this, what would this be? What would this specific number be? What do y'all think? What do you think this amount is? Okay, well, I'll do it. It's going to be equal to this, 147,877.33, right? It's literally the sum. This number here is the sum of these two. By definition, if I did this, we would have the same number. Whoops. There you go. Oh yeah, I guess I can see how that's. Anyways, but the idea here is that yeah, it's 147,000. So okay, interesting. How come it's not the same number as the journal entry? So you're talking about how come it's not the same number as this thing here? Yeah, okay, amazing question. The reason why it's not the same thing is because remember, we're actually trying to make that number get to 0. We're trying to make our premium on bonds payable converge to 0. And that's why this number is going to get smaller and smaller every single year. So if we did this every single year, so 2014, 2015, etc., this number would actually be smaller. And at one point, it's going to be equal to 0, such that carrying amount on bonds payable is equal to 0. So that's how we go about requirement 2. All right, so let's try to ramp up onto the third requirement. Okay. So, all right, let's go about this one. So if it was a discount, we're just going to do it inversely. And we're going to have a question in which we have a discount. So we'll be able to jump into that. All right, so you'll see exactly how we go about it. It's going to be some cool stuff. So this said, we could now look at this idea of redemption, right? What happens when you want to redeem a bond? All right, so the company, the government, okay, wants to redeem 10% of the outstanding bonds for cash at 102% immediately after the first interest payment on September 1st, 2013. And then we want you to prepare this journal entry. Okay, so there's a lot of stuff going on here. There's a whole lot of stuff. And I'd like to divide this once again into bite-sized pieces to make sense of it. So we know that this is happening after September 1st, 2013. Well, in this case, it's actually September 1st, 2014. No, 2013, sorry. So we want to do this after the first interest payment on September 1st, 2013. And we want to also understand what would happen if the company buys back the bonds, whatever is left of the bonds, for a premium of 102%. And they're only going to do this for 10% of what's left. So there's like a lot of stuff going on here. There's a lot of stuff going on here. But what we're going to do is we're actually just going to try to divide it into simple little steps. And like that, we'll be able to do it in a little bit of an easier manner. It's going to be a little bit more simple for us. So let's do that. Let's do that. So let's start by essentially creating the journal entry for the first interest payment. What happens after the first interest payment? All right, let's do that. So what's beautiful about this schedule is that we're able to literally just go with it step by step, right? So let's look at September 1st, 2013. Now let me ask y'all, what would be the interest payable for September 1st, 2013? What do you think it would be? If y'all found the answer for this one, you should be able to find the answer for this one. What would be the answer here? Okay, Daniela, I like where you're going, but is that it? Are we missing something? Did we jump the gun? Did we jump the gun? Don't forget, we need to follow our timeline. We need to follow the steps of what our schedule shows. What about the others? What do y'all think? What would be the specific amount we would put here, knowing that technically there was an interest payable journal entry of this amount? What would be left here? How many months have passed between the two, right? Like this is after 6 months from March 1st to September 1st. But we had to put something here. We had to put something right here, okay? Think about it. Daniela, you have the first section of the question correct. But maybe you jumped the gun just a little bit. Maybe your number is a little bit too big. There you go. Amazing. Yes, exactly. So don't forget that if we go back to our drawing, this right here is our first like payment, like our first like period. So we have March 1st, 2013, and here we're gonna have September 1st, right? And the idea is that all of this should be equal to 40K. Our interest payable should be equal to 40 grand, such that this, if this didn't exist, sure, what Daniela said at 40 Gs was okay. But we have to consider that we already made this journal entry. We already had a journal entry, right? If we go back to our statement of financial position, we already added this number. So it would make no sense for us to say that the interest payable that we're gonna record here, sorry about that, is equal to, 40K. That would give us a bigger amount. So that said, this could be equal to $40,000 minus this amount. Do we all understand why this is equal to 33,333.33? Cool. Amazing. So let's run with this. All right. So what about our interest expense? What would be our answer here? What would we do here? How would this make sense to us? How would this make sense to us? If we know this was a formula we used with 1/6, and we know 5 months have passed, right? 5 full months have passed, in this period, what would be the answer here? I want you guys to tell me, what would the answer be here? What would be our answer for interest expense for B? What would that be? No pun intended. What would that be? What would we put right here? Okay, I like the tries. I'm loving the tries. Okay. Okay, so what I'll do is this. We're gonna use the same formula. Okay. And I'm gonna ask y'all to tell me what these bits mean. So we have, once again, the price that the market has paid. We have our 6%. We divided it by 2, and that gives us a payment for one single period, right? For essentially one specific payment. And then we divided it by 1/6, or we divided it by 6 because we're looking at 1 month. But now we want to look at the next 5 months, right? So wouldn't it make sense for me to do 5/6? Like, does that make, do we see this? Do we see why I did, instead of 1/6, I'm doing 5/6? Because I want to look at the 5 other months that have passed within that specific payment period. Because we were only here, we only did 1 month, but there's still 5 months that we need to look at, this section right here. So that's why I'm making this 5/6. And that's why it's giving us another amount. Does that make sense? Just to make it even more clear. This plus this gives you 40K. And this plus this gives you this amount that Olivier gave us, right? But what I want you to understand is that this is equivalent, and I'll put it right here. Actually, give me a sec to insert one here. Perfect. Months passed since previous. Give me a sec. I'm just trying to make this look like it makes sense. Okay. So in this case, 1 month has passed. And in this case, how many months have passed since the last period? From March 31st to September 1st, how many months? You could literally use your hands if you want. How many months have passed? Well, yeah, there you go. Amazing. So 5 months have passed, right? So essentially, we made our full interest payment. We made our first full interest payment, right? At September 1st, our first full interest payment should be recorded. And that's the case right here. 40K will be equal to the sum of these two, which is that's our interest payment. So do we all understand that 40K is equal to one interest payment? And by September 1st, we would have done that full interest payment in like journal entry-esque vibes. Do we get that? Does that make sense? So you see how these two are equal to their respective total payment? Do we have any questions? I think that's a better like question to ask. Do we have any questions? Is there anything that's not clear? Like, do you totally understand this? Or is there any questions? I'm gonna take silence as a yes. Okay, cool. So that said, what's the difference between these two? Can somebody tell me in the chat? I'm gonna get the answer, but I want you to participate. So what is the difference between the two? What is the difference between the two? Nice, thank you so much, Olivier. Thank you. And by definition, then our carrying amount will be equal to how much? Let me try to test you guys a little bit more. What would be our carrying amount at that date? If we know we want it to come equal to $1 million, we want to amortize it. Yes, and what would that be equal to? I need to be a little bit annoying. I'm sorry. What would that specific amount be? I just want to kind of be annoying. Thank you. I appreciate it. I really do. So yeah, now this is how our thing would look like, right? It would look like this. Okay. And thanks to this, we're able to actually build a journal entry. So we're going to try to do exactly that. We're going to try to build a journal entry based on the different information we've received. Okay. So let me ask you all a few questions. What do you think would be in our journal entry? Could you just add it into the chat, like just the name of those accounts? What should be in our journal entry when the company makes their first interest payment on September 1st, 2013? What should be in the journal entry then, and why, if you can? Actually, I'll explain why, if anything. So yeah, what would be in our journal entry at that date? Nice. Okay, that's two good things. What else? What's something guaranteed that's going to be there, right? The first interest payment paid by the company to the bondholder. Nice. Okay, good. And then I think we're missing one last thing. What is something that we're trying to do again? Why are we doing the schedule? What are we trying to do? We're trying to amortize. And what are we trying to amortize in this case? We're trying to amortize this specific thing that we called in our first journal entry. Yes, exactly. So we're trying to amortize our premium. So now let me kind of like take a step back and define these four different journal entries that we've discussed, actually these 5 different accounts. So the first thing that we want to do, on September 1st, 2013, when the Office Inc. will be making their first interest payment to bondholders. The most obvious thing here is that we're going to have to pay cash to bondholders. That's for sure, right? And the amount of cash that has to be paid, well, we know that. It's equal to the annuity payment that is owed. And that in this case is equal to $40,000. But then we need to balance our equation. And we're going to be able to balance our equation with all the different things that we've uncovered thanks to our schedule. Let me show you how we do that. So we're going to work a little bit inversement. So we have we're going to have this here. So do we all understand that we have to credit cash? Are we all okay with that? Does that make sense? Like the bond issuer, the government, has to pay the bondholder that amount. And how much would that payment be on September 1st? What would that be? Equal to how much? 80,000 or 40,000? Do we all agree with Daniela? Really quick, just for fun. Nice, cool. Okay, so we know that. We know that for sure. So we know that this must be equal to $40,000. Now the thing is, how do we balance this journal entry? I think it's pretty obvious that for sure, there is some interest expense to look at that specific date. There's some interest expense that we didn't account for yet. And that interest expense was given to us thanks to our schedule. And another thing that I'd like to share with you, and this is very important. When you're making a journal entry, especially with chapter 10 for bonds, the journal entry at that specific date must only look at the values for interest payable, interest expense, carrying amount for that specific date. So you cannot use the values here because you need to assume that the company already made those adjusting entries, right? So we're only looking at this specific date. At this specific date, what was the different interest payable? What was the different interest expense? What was the difference, etc.? We forget about these, okay? So we're only going to rely on these specific values, all right? It's very important. So that said, what I'd like to also remind you, remember how we had interest payable of 6,667, whatever? Obviously, if we're paying cash to the bondholder on September 1st, do we still owe them that money? Yes or no? If we paid them 40 Gs, do we still owe them 7 Gs from the past? Yes or no? I need to see a bunch of yeses or nos. Olivier says no. What about Leandra, Daniela? Okay, amazing. Okay, cool. So by definition, no matter what interest payable we had in the past, there's no way we're going to have it still. And in this case, our interest payable was of 6,666.67. So therefore, we must at least debit, our interest payable by that much. Okay, so this is super important. Now, we have a few other points that we'd like to cover as well. I think I actually skipped one by accident. Don't need all this. So that's really relevant. Okay, so then the only thing that we'd be missing, I'd actually like to also add our interest expense. So with what I said in the past, what would be our interest expense? If we have to look at our amortization schedule, what would be our interest expense as of September 1st, 2013? Nice. Nice. Good stuff. Okay, so there are two ways for you to solve this. There's the, shoot, I don't know what to do. Let me just try to solve the puzzle. And then there's the actual rational perspective. So in order for you to find what needs to be added here is you need to remember the nature of the question. In this case, we're trying to amortize our premium for it to be equal to 0, right? So because our premium at first was credited, if we're trying to take off, we're trying to reduce the premium, then we're going to have to do what? Are we going to have to debit the premium or credit the premium? Thank you so much, Daniela. Yes, we're going to have to debit it. Now, the question is, by how much are we going to debit it in this specific journal entry? Thank you. There are two ways about doing this. You could either just do this 40K minus 28,000 minus 6 Gs. That's going to give you the amount. That's one way of going about it to make sure that the journal entry balances. Or you could rely on our schedule. And our schedule literally tells you it's a difference between A and B. That is the premium for that specific period. And it wasn't that hard, right? Like we had all the information, we just had to make sense of it. Now let me ask you all a question. I know we're spending a lot of time on one specific problem, but we're really making sense of it. And I would like to ask y'all, up until now, are we comfortable? If you see this on an exam, do you feel better off? And also, before we started this session, do you feel better off? Maybe if you four could say yes or no, so I could kind of see how I would allocate the rest of our time today to focus a little bit deeper. Okay. Okay, so that's good. Amazing. So with that said, this is really important. That was the first step, finding the journal entry. This is something that you'll have to do on an exam, most likely. And they're going to give you options and you'll have to write it down, either multiple choice or like by hand, depending on how it'll be. But now we're not done yet. We need to find the second bucket. We need to look at the second perspective of this question, which is, well, what happens if they redeem, right? If they redeem 10% of the outstanding bonds and then they pay a $102 premium to do so. It's a whole lot of things going on here, right? There's a whole lot of things going on. And what I'd like to do is I'd like to maybe just break it down into steps. So let's say company redeems 10% of bonds. What does that mean for us? How much of the bond payable are they redeeming? Can somebody answer that question just for fun? In value. How will we do this? Does anybody know? Let's say this. Does anybody know? If you don't know, I could tell you how. It's really not that deep. It's fairly straightforward. Does anybody know how to do this? I don't know. Okay, cool. Okay, Daniela brought a really good point. So yeah, when they're saying that they're going to redeem something of the bonds, essentially what you want to do is you want to take the redemption percentage times bond payable. So in this case, we're going to do 10% times, whoops, times 1 million. Okay. So can somebody tell me what that would be equal to? What would 10% of $1 million be? Perfect. Amazing. So it's $100,000, sorry. Now, just to give you a little bit more context on what this means and why this matters, it's because let's think about it. Let's say we wanted to buy a brand new Mercedes, like a brand new AMG, I don't know, AMG GT63, if you like cars. Like we bought that $260,000. We spent a lot of money, but we took a loan to buy the car. When we have a loan, technically we're allowed to repay a portion of our loan in 2 years, right? Let's say our loan was 5 years, we're allowed to kind of cut off from that loan here and there, right? And that's exactly what the company is doing. The company is like, shoot, I think I have a little bit too much debt with these bonds. Let me buy back a portion of these bonds such that I don't have too much debt. Or the company was like, you know what? I have a lot of money now. The business is doing great. Let me buy back some of this debt while I can, right? So do we understand why a company may want to repurchase some of their bonds? It's just a question of like, oof, too much debt. I want to take it back. Are we good with that? So they're trying to eliminate debt. Eliminate a portion of debt. Do we have any questions up until now? Don't hesitate to cut me off. So yeah, the company wants to redeem a percent of their bonds, which is at $1 million each, because they would like to eliminate a portion of their debt. Simple as that. But the thing is, they need typically to pay a premium, sometimes even a discount, but typically they pay a premium for this because the people who lent them that money, right, would like to, still get those interest payments, right? It'd be kind of unfair to them if you just you just broke the loan agreement, right? So in order to do so, the company is going to pay a premium. And they said it's at 102%, at 102. So what this means is that the company is going to pay a 2% premium on every dollar that they repurchase. So to make this really simple for you, all that you have to do is you need to do this step first. You need to figure out, right? Especially you need to figure out this number. You need to figure out how much are they repurchasing per bond. And then all you have to do is take your 102% and multiply it by $100,000. Now, what does this figure mean? What is this specific value all about? This value is how much cash the company will spend to redeem one bond. Okay, so the company, or the government in this case, wants to redeem $100,000 of their debt. They want to kill that debt. So they're going to spend $102,000 to be able to do so. Okay. So far, are we good? Do we understand these two categories, these two subsegments, these two ideas? Perfect. Good. So that's super duper duper important. So now what I'd like to do is I'd like to create our journal entry. Okay. I'd like to start off by creating our journal entry, and we're going to try to make sense of this as we go step by step. We'll go somewhere else. We'll go over here. So we have this journal entry. September 1st, 2013. All right. So what we know is that the company will for sure, in this case, so what do we know? We know the company is going to have to essentially spend some cash to be able to redeem their bonds. So that in that case, that cash will be debited or credited. What's going to happen to that cash? What do y'all think? Oh, whoops. I almost gave y'all the answer. Is cash debited or credited? The money they're spending to redeem their bonds. I mean, I gave y'all the answer. But yeah, cash will be credited. Do we understand why cash is credited? Can everybody say yes or no in the chat? Do we understand why cash is credited? Okay, cool. And what would be cash? Was that equal to 100K or 102,000? Which one?
102.
Nice, thank you. Yes, cool. And then what about bond payable? We're eliminating a portion of bond payable. So are we debiting bond payable or are we crediting bond payable? You had debt, you had $1 million worth of debt, and you're removing $100,000 worth of that debt. You're removing that debt. You're destroying an accounts payable. It's gone. You're not adding to debt, you're removing debt. So are we debiting it or are we crediting it? Essentially, our debt is decreasing. Our accounts payable is decreasing. There you go, exactly. So yeah, we debit it. The reason why we're debiting it is because, if you remember, when we increase debt, we credit it. When we decrease debt, we debit it. So in this case, we're gonna debit that by 100 Gs. So now, obviously, we see that it's not balancing, and for sure we're missing something, right? We're missing this idea of our premiums on bond payable. We're really missing that idea. We're missing the idea of, well, what happens to bond payable once we redeem a portion, right? What's going on to that number? Now, what I'd like to ask y'all a question. Do you think a premium on bonds payable will ever be credited ever again after the date of issuance? Would that make sense? Would a premium on bonds payable? Exactly. It will never be credited again because the only way for it to be credited is on the date of issuance. That's when we find like the delta, how much money extra they made, such that any other journal entry after the date of issuance, if you see premium on bond payable, it has to be debited. So already now we know that this right here is equal to is a premium on bond payable. Now the thing is how do we find that number? How do we find what we're going to debit of our premium on bond payable? Now, this is really cool because there's an easy way of going about this. And you could literally just rely on our schedule. And to be honest with y'all, I could even make it a little bit simpler for you. I'd like to just perhaps put these in like brackets because you don't need to add this on your exam. Like your teacher won't give you points for this. but you could still put like a few reference points. So value and premium on bond. So this is something that you don't have to do, but it's pretty important. Like you could see how much is literally in by doing this, you'll actually see how much is left in that account, right? That's what I want you to be able to see. Do we understand what this means really quickly? I kind of like didn't say it too clearly, but yeah, this is like literally the account premium on bond payable, right? And essentially we know that the account premium on bond payable gets smaller every single period because we're trying to amortize it. And essentially what I did is I just took this amount or these amounts minus $1 million. So minus our bond payable, and it gave us this amount. Are we okay with that? Does that make sense? Just everybody quick yes or no. It's okay if it doesn't make sense. Amazing. Thank you. So we know that as of September 1st, this is our account, right? We know that this is what's left on our value and premium on bond payable. But then let me ask y'all a question. If we're taking 10% of our total bond, that means that we're also taking 10% of our total premium on bond payable. So with that in mind, can you tell me what would be the value that we would have here? Can you tell me what that would be? No problem. No problem, Leandra. So could you please tell me, what would this be? What would the value be here? Alexander, Olivier, Daniela. What would this value be? If we know we're taking 10% of our bond payable, and by definition, we're taking 10% of whatever is left in our premium on bond payable, what would this be equal to? Apply the same math that we did before. 10% times something will give us the value we need, right? 10% 1 million gave us 100 Gs. And then obviously we have to find our little premium. So what if we did the same thing for our premium on bond payable? What would that be equal to? 10% of something highlighted in yellow. Wink, wink. What would that be equal to? What would that be? Any ideas? This would be our value. This would be what we would need to debit for premium on bond payable. Let me tell you why, right? What we did before is we essentially took, we go back right here. Sorry about that. We took 10% of our bonds, right? So we took our redemption times bond payable. So 10% times 1 million, and that gave us 100 Gs. But that same idea has to be applied to our premium on bond payable at that date. And that's why we got, in this specific case, does that make sense to us? Are we okay with that? Yes or no? Yeah, okay, cool. No questions? Nothing weird? It's okay if you have a question. I know it's been like almost 3 hours. I can see why we're like a little bit tired. I totally get it. But that's why the group is cool, because you'll be able to ask a question at any time. So don't hesitate to kind of like let this marinate a little bit. Okay, so now let me ask y'all a question. Does this balance? Is this balancing? Yes or no? No. Okay. So by definition, in order for this to balance, what would we need to have in this specific like little box here? What would be the number we need here? Nice. Thank you so much. You killed it. You killed it. Good stuff. Okay. So we're missing this value. And this one is a scenario where you just need to kind of understand what this is. If we go back to this idea of gain and loss, because the company made more money, right, on the issuance of their bond than they expected, we could also think about the premium as being like a gain, how much money they made extra. So we're going to apply that same idea. What is left over is what we're going to call a gain. Simple as that. And conversely, if we had a discount on bond payable, we would call it a loss. So whatever is left over, just remember that that's equal to what we call a gain, all right? So before we proceed to the fourth requirement, you could just call it gain. Just call it a gain. That's literally all you need. Just call it a gain, you're fine. You could call it gain on redemption if you want, at worst, but just gain is totally fine, Olivier. What would I like to say? Yeah, so we have one last requirement to do. I would like to ask you, do you have any questions about the third requirement? It was a heavy one. Do we have any questions? Was anything like confusing? No? We're okay? How are we feeling? Are we feeling good? Are we tired? Right? Good, tired, I don't care. What do you think? Perfect. Good stuff. Amazing. Cool. So that said, let's look into the final requirement. Then you guys get to rest a little bit, because I know it's a lot of stuff. But that's why we're starting early, such that you're gonna kill the final little 100% type of thing. Okay, so we know that we have our remaining, we have the remaining percent of what's left of the face value. We have 90% left, right? And we say that this is gonna remain the case until maturity. So now we're gonna ask you, what would be the total interest, well, geez, sorry about that. What will be the total interest expense from September 1st to from September 1st, 2013, all the way to March 1st, 2023. So we're asking you, how do we find the total amount of interest expense to be paid? All right, how do we find that? And honestly, it's pretty straightforward. And I think we could break it down into easy ideas. All right. So we want to first and foremost figure out that, hey, don't forget that we only have 90% of what's left over, right? We had $1 million, now we only have 900K of the total bond payable left. All right, so that's one thing. Another thing that we want to know is we want to find the total interest expense, not the total interest payments, okay? So what does that mean, that little distinction? What we want to find is we want to know, well, obviously our interest expense is not necessarily equal to our interest payable, right? So what we're going to do is we just want to find, essentially, what that total interest expense will be after those 20-some years. So what you could do to make this easier for you is you also need to remember that this is happening from September 1st, 2013, all the way to March 31st, or March 1st, 2023. So we're not including these times, okay? Not to include these specific times. Now, the way I would do this to make it simple and easy for you is I would just look at something very easy. I would say, look at your total interest payable, okay? Then you're going to subtract your total premium to be amortized. And that's going to give you your total interest payment. Now, you may be like, well, Ismail, why is that the case? The reason why is because we have our interest payable here, and we know what our difference will be, right? We know our total difference, no matter what. So by just doing this minus this, you'll find this. Now, there are different ways for you to do this. You could also literally just do it period to period, period to period, and you'll have your amount. But this one's fairly easy. So just follow my steps. This is something that you don't always see on an exam, but it's good to have exposure to. So what would be our total interest payable, right, from September 1st to March 1st, 2023? How would you find this number? Can you give me ideas in the chat? Like, how would we do this? What would you look at? How would we do this? Let me give you a hint. We have $40,000. Olivier, okay, I like that. Okay, that's not bad. I like where you're going with this. This is good. Okay, so we need to look at interest payable, right? But what we need to remember is that let's assume that we're just looking at one like payment period at a time. and we know that one payment period is equal to $40,000. And we know that we only literally passed one period. So there's still 19 other periods to go. Do we agree that there's still 19 other payment periods to go through? Just say yes quickly in the chat. Does that make sense? We still have 19 periods to go through. Like, you know, this is just one period. Remember, one period? We still got 19 other periods to go through because we have 20 periods. Okay, cool. So 40,000 times 19, right, would give us this amount. It would give us this amount. But the thing is, what we need to not forget is that we're only doing this to 90% of the face value, right? So we're only actually going to pay 90% of this amount. So this will actually be our interest payable. Sorry, at that date. Do we agree that this number makes sense? Could we understand how we got to this number? So we did $40,000. We have 19 periods to go through, and that gave us $760,000. But 760,000 represents 100% of the bonds. But now we know we only have 90% of the bonds. So it would only be right to look at 90%. And that's why we did 90% of $760,000. And that gave us this amount. So Alexander, Daniela, Olivier, are we okay with that? Quick why in the chat. So why 19 payments? Really good question. We're looking at 19 payments because if we go back to our schedule, we know that there's 19 payments to be done, like 20 payments total, right? There are 20 specific individual $40,000 payments. But we already had, like, we already did this payment. Like this one already happened, right? Because we're on September 1st. Now we're looking at it from here all the way to here. Perfect. Nice.
Hey, Ismail, sorry to interrupt, but I unfortunately have to go because I have a class that starts soon. But I have two questions, kind of like based on the other sessions. So will we get the answers to the other two problems? Yeah. Okay. And for the other sessions, are they kind of, so will you like tell us about the session in like a group chat before, right?
Yep.
Okay. So, and are they all $25 then for each session?
Yeah, well, you could send me a text, we'll look at it and we'll make sense of it. But essentially we have a boot camp like setup. Okay. Camp setup is going to be like the price, but we'll look at that together. So just send me a text. But how it's going to work, if you remember when we spoke, is that there's a schedule. There's 6 sessions that we're going to do. And essentially the boot camp is that you get like a pretty big discount on all of those different sessions. And each session, we're going to look at one specific topic. Ideally, we're able to go through those 3 problems, but that may not always be the case. Like tonight, we only did 1. But then I do the solutions like step by step for the other problems. And then the other session, we look at the theory and we jump into each chapter. And then we're going to have 3 final sessions, reviews on like the Saturday, Sunday, and like Thursday of the exam week. All right.
Okay.
Perfect. All right.
Gotcha.
No problem.
All right. Well, thank you very much.
No problem. It was a pleasure. So for Daniela and Olivier, we got 5 minutes, I think. Let's try to crack the last part. Are we okay with that? Are we excited? Perfect. So what we're going to do now is we're going to essentially go back to our problem. So we have 90%, right? But the thing is, we need to look at what is the premium that is left to be amortized. And it's really simple at this point. All you got to do is you literally just got to look at this. So we know at September 1st, we had this much of our premium, right? The only thing that now you need to look at is you need to remember that we eliminated this much of a premium because of the redemption, right? Such that our total actual premium is equal to $128,000. Such that if we go back to our idea of interest payable minus premium will give us our total interest expense, all you have to do is subtract the 2. All you got to do is subtract the 2. And you will get the total cumulative interest expense. Yeah. So yeah, does that make sense? Yeah, so good question, Olivier. So what we did is let's break it down. Could we all agree that this is how much we have in our premium on bond payable account as of September 1st? Yes or no? Cool. Can we also agree that we had to eliminate 10% of what was left in that account because we redeemed 10%? Yes or no? Yeah. And that 10% was equal to this amount. Yes or no? Exactly. Because we eliminated it, like it's gone, right? Like by definition, what I could have done, and I could see why that's a good point, after redemption, I could have done this as well. Like we could have done like a little change to this amount, right? We could have done that, but I'm sorry. Next time I will do that for our solutions on the two other problems, because that is a little bit more accurate. You're right. So yeah, that's how you solve the 4 requirements. Now, before we proceed, like before we actually conclude, I mean, do we have any questions like overall on this? Like any logistic questions, any general questions, any ideas, blah, blah, blah. What do you think? Are we anything to share? What about you, Daniela? Anything to share? Okay, so listen, I'm sorry that we didn't get a chance to look at problem 2 and 3. I will be going through the solutions, like I'll send them in our group. And then also what's cool is that we have 3 final reviews together. I'm obviously going to add the two bond problems that we didn't do, right? That only makes sense. So we'll add that. So you're for sure going to get exposure to this. I definitely do recommend that you do them beforehand, right? Because you're going to have the solutions. Might as well like still try them. And that said, I hope tonight was helpful. I hope it gave you a sense of what this is all about. And I hope to see you on Thursday, if I'm not mistaken, or something like that, like our next session. So yeah, no problem, no problem. Always a pleasure to help. You know, it makes me happy. So I'll see you on Sunday.
Thank you. Have a great evening.
Yeah, you too. Thank you so much. Bye-bye.